on the sectors somewhat, not at super granular level, but once you see kind of energy and some of the others, their earnings obviously are holding up because this is a good environment for them. And technology seems to have maybe priced in a recession more so. I mean, I look at a very simple perspective is the year-on-year rate of change of, let's say, the nazdaq and the S&P. You can see in the nazdaq, it's pretty much priced in ISM at 42, kind of fully there already or very close. Yeah. What are your thoughts?
Yeah, no, I agree. And it's interesting, energy, for instance. When you look at the consensus earnings estimates for the market, they're like eerily quiet. They're at 4% growth for the second quarter, which we're just starting to report now. But you strip out that little tiny energy sector and you're down to -4%. So earnings are already starting to contract. But the big tech or the big growers, the long duration stocks were obviously caught in the crosshairs of this rate reset. I mean, 10-year yields like a 1% a year ago or something like that, and it's 3% today. Real rates went from -2 to +1 in pretty rapid order. The long duration stocks, which by definition means discounting a long stream of earnings, those are very sensitive to changes in the discount rate or the cost of capital. And so they fell hard, as you would expect them to when interest rates rise rapidly. But now interest rates, I think, have peaked for the cycle. The terminal rate has gone from 4% to about 3.5%, and the relative performance of the large growers to the S&P or to small value, if you want to make an extreme pair trade out of it, is very highly correlated to changes in interest rates. And so, the leaders during this downturn have, of course, been the defensive names, utilities, consumer staples. But the staples are starting to get hit by the strong dollar because they're very sensitive to currency moves, and utilities have gotten kind of expensive. So I think the leadership actually is returning to the big growers here. And as you said, they've already discounted a lot of bad news.
Actually created a basket of further out the nazdaq, so the real kind of growth end of the market, did a whole basket of stuff, and I mean that's pricing the ISM at 38. Yeah. So I mean that's a full and deep negative 2%, 2.5% recession. So I totally agree. Before I move on to bonds, which I want to get to because they are the most mispriced versus where we are in the business cycle right now. When you go around Fidelity and to speak to the analysts and say, why haven't you taken down your forecasts? What do they say? Because I always find it amusing because the macro guys are always looking at the forecast and the bottoms up guys are doing different stuff. And sometimes we see different pictures and one time one side is right, the other side is right. What do they say when you talk to them?
Well, our analysts have been, correctly positioned in terms of lowered expectations, and I don't want to say that I speak for my colleagues in saying this, but that there is a sense that sometimes the companies who, of course, guide the analysts, the sell side analysts, we're of course the buy side, but the companies who guide the analysts who then lower their numbers, that hasn't really happened yet, right? The numbers are kind of still up there, still expecting 10% earnings growth for this year. Now, part of that is energy, again, as we mentioned earlier. But there's a sense that sometimes the companies themselves are the last to know that their earnings are not going to hold, and so maybe part of this is just a game where everyone is just pretending that the numbers are fine until they're not, and then they get guided lower. But we are coming way down, of course. But the backward-looking CPI is up 9%, and it becomes a question of how much companies can push those prices onto consumers at this point in the game.
What is your hunch here? Do you think that we do take down earnings? Now, they're coming down already, as you said, it's kind of being hidden by the energy sector. Do we take down earnings further so we get to the 33, 35%, and we're kind of there for price? And again, I use the year-on-year rate of change. That would bring us down to, versus the ISM, would bring us down to the low 40s.
Tricky question, because you look at the headline economic data, obviously the ISM has rolled over, but that does, you need to get into the high 40s, as you know, on the PMI to be consistent with negative GDP growth. And of course, we do have negative GDP growth, but it's not really a consumer-led negative GDP growth, right? It's inventories, exports, it's stuff like that. And then you look at the payroll number, we're still printing a few 100,000 a month. Hard to, and I look at the TSA data, 2.4 million passengers a day. Consumers don't seem to have gotten the memo that a recession is imminent. But again, maybe they're the last to know, right? Because they're not going to stop spending until the jobs start disappearing. And we already see, news that companies are not hiring as much, but they're not really laying off in droves either. So I do think it's premature to say that certainly that we're in a recession. I think clearly I shouldn't say clearly, but my guess is that we're not in a recession other than the technical definition of how GDP is constructed. 50% growth rate 6 months ago, it's about 15% now, probably on its way to 5 or maybe even less. When I look at the internal numbers, so when I look through the consensus estimates and I look at the breadth of the number of S&P 500 companies that are seeing their earnings estimate go up versus down, we've gone from 90% a year ago to now 40%. But even that 40% is not necessarily a recession level. You just, you can lower earnings estimates, but still be positive on a year-over-year basis, right? If that makes sense. So I'm not at all ready to ring the bell on a recession, but clearly we're in an advanced late cycle phase of the market and the economic cycle. And clearly things are slowing. Consumer disposable income is being eroded by inflation. Companies are going to have a tougher time passing on their higher input costs. It's interesting. And in terms of your question on just consumer confidence, obviously the confidence numbers are low, but I think a lot of that is actually tied to the inflation. I mean, inflation is a massive problem, right? I mean, it's 9%. Many people have never had to deal with that. You have to go back 50 years, and not everyone was around 50 years, 50 years ago. But if you look at the consumer surveys, the confidence numbers, and you tie them to, for instance, employment, the numbers are much higher, right? Because people are employed, the labor market is super tight. There's some pricing power on the wage front. So I think a lot of the consumer confidence survey data can be tied to just the inflation problem, which of course is massive right now.
Yeah, I mean, I put together a model of the rise in the year-on-year rate of change of interest rates, commodity prices, and the dollar as a financial conditions index that's a bit broader. And this has been, because of rate of change matters, it's been one of the larger tightenings in history, and the fastest. So, it should slow economic activity, and that's what leads me to believe that yields come lower.
And you have this great chart that you showed me the last time we were on with, I forget when that was. I'm just curious how that chart, obviously that was very, 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 very prescient. Just curious where the data points are at this point.
So that actually got down to an ISM of 35, 36. And it's starting to turn up because rates are starting to come down and commodities have rolled over. It forward-looking suggests that we've got a sharp air pocket in the economy out to 9 months. But much to our conversation, the NASDAQ's pretty close to having priced it in. The S&P might have a bit further to go. It's somewhere within these bands that you and I were talking about. The low being whether that was the low or whether we got another push to price this in fully, because the year-on-year comps are actually quite difficult because all the markets were screaming higher from this point on last year. High yield spreads, small caps, cyclicals, defensives, they're all kind of roughly where the ISM is now, slightly leading it. And it's the US Treasury 10-year yields that's way off.
Yeah. I think we need to get to the end of the Fed path. I mean, the market's still pricing in about 200 basis points further of rate hikes just this year, right? And a lot of airtime, I think, is being spent on speculating whether the Fed goes 75 or 100 or 50. Like, I don't really care. It's like, where are you going to turn up? Where are you going to end up, right? Is it 3, 3.5, 4? I think that's the most important part. And what's interesting is that as expectations get ratcheted up towards a tighter Fed, on the other side of that forward curve, expectations are growing that it will be very quickly undone by rate cuts, right? So at this point, the forward curve, the SOFR curve, has a kink in it. It goes to 3.5, and then it goes to 2.5 after that. So the market believes that if the Fed is forced to push this thing, it's going to break the economy and create a recession, and then going to have to, come back down. So, hopefully the Fed ends up not having to go as far, because the forward-looking inflation data are starting to improve, if we can believe the bond market at least. So we'll see, but we're going to find out fairly soon. But I agree that anything north of 3, in my personal opinion, on long rates has some value, and certainly the long demographic wave and all that stuff hasn't gone away at all, right? So, but I think what will be interesting over the next, let's say, 6 to 12 months is, let's say inflation comes down here. I think even the biggest inflation bears will say that the rate of change should start to improve. I mean, oil's down, copper's down, used car prices are down, everything is down, so it should start to improve. But what will it improve to, right? So if 6 months from now we're in a recession, again, not my base case, but let's say it happens, or 12 months from now, and inflation the CPI has gone from 9, but is only going down to 4 instead of down to 2, what does that do to Fed policy and this dual mandate balancing act that they have? Will that remove the Fed put, because they just won't have the leverage to lower rates as far as they otherwise would, because inflation is above their target? I think, to me, that's going to be the next big conversation that we're going to have.
Yeah, and people are having that debate. I'm taking the other side of it for now. And again, we're all probability guys and we adjust our frameworks as we go. I actually think, and you and I have talked about this in the past, that we might actually be close to 1947 to 1949, where inflation went from plus 20 to negative 6. Yeah. I actually think we go negative, but that's not the game to play right now. The game to play is looking for the turn of the cycle and the Fed cycle and the interest rate cycle, I think.
And you mentioned the 46, the 1940s. You and I have both used as an analog, and that's been a very good one to use during this whole pandemic period. First in terms of like 42, 43, all of that fiscal monetary firepower being unleashed and what that did to the market. And then kind of now on the hangover side, where you had the end of the war, hopefully the end of COVID, but with this inflation hangover, S&P went down 26%. And then it sat there for 3 years until 1949. And there was no earnings recession, because typically when inflation is high, nominal earnings, which of course is what most people will look at, are okay. Earnings were okay in the 70s. But the valuation side is where the haircuts are. And the PE ratio from 46 to 49 went, I think, from 22 to 5. Now, I'm not suggesting we go to 5 here, but that is an enormous PE haircut, and that's why the market didn't recover right away, even though earnings were okay. It's because just nobody wanted to pay for those earnings anymore, and so that it's a good example of a purely valuation-driven bear market in a period of high inflation.
So people are probably wondering why the hell we're talking about all this macro and why it matters to crypto. And the point being is, we both think we're in the zone where things are going to change. Perceptions of inflation, perceptions of interest rates, and perceptions of future growth expectations and how you discount it may well change. So talk us through how this fits into crypto, and then we'll dig into some of the other things you've been doing in crypto, because I think you do some of the best analysis out there, bar none, and I think it's super interesting. But just give us why macro matters to crypto so people can frame that.
Well, I think macro matters. So I focus mostly on Bitcoin, a little bit of Ethereum, but that's those two are really the only ones I've done extensive work on. And Ethereum to me, and I think you agree with me, is a technological revolution, but it kind of goes on one side of the risk, not of the risk spectrum, but like of the 60-40 spectrum, right? Like that's a kind of a growthy venture type of asset based on changes in technology. Bitcoin has that, of course, but it's also an aspiring store of value. And I say aspiring because it hasn't quite proven itself yet, right? It's still coming of age. It's still trying to get up there alongside of gold as a store of value. And until it has proven itself, it's kind of a venture asset, right? And as we've seen over the past 6 months, Bitcoin, as much as it tries to be the anti-fiat, still suffers from the whims of stuff that happens in the fiat world, including leverage and speculation. And of course, we're seeing that winter unfold before us. But the macro narrative, I think, is important in providing kind of the recognition point or the narrative for adoption, right? So we saw, of course, in 2020, I think Bitcoin bottomed at 3,000. Then we had the pandemic, we had the policy response, again, like from the 1940s playbook, that high octane fiscal monetary policy, and Bitcoin went off to the races. And I think part of the value proposition was, okay, we're going to print ourselves into oblivion. M2 growth is just off the charts. The excess money, as we call it, the difference between money growth and GDP growth, I think went to like 35% or so, the highest probably since the 40s or the 70s. And that, I think, provides the narrative for the bystander, not the Bitcoin insider, but the bystander to say, yeah, that makes sense. And so that the person who is not going to spend 500 hours understanding Bitcoin, but who sees it as a coming of age asset class, I think the macro narrative becomes important, unless you're just buying it because the price goes up, which of course a lot of people do. But if you want something more than that, it has to fit into kind of a worldview and this notion of an extended period of extremely loose policy, negative interest rates, rampant money supply growth. Those have all been good periods for gold in the past. And if we put the store of value hat on for Bitcoin, I think that was probably part of the narrative in 2020 going into 2021. And now that the Fed has reversed so quickly from that playbook, not that this was the Fed's playbook, but certainly I thought that we were going to have a multi-year period of extremely loose policy, and that the U.S. would follow kind of in the footsteps of the 1940s Fed or the modern day Bank of Japan. And who knows, maybe we still will. It wouldn't surprise me if after this cycle we go right back there.
We have yield curve control. Yeah,
we have yield curve control. We cap the bond yields just like the Fed did in the 40s. And we see what the Bank of Japan is doing, right? They're doubling and tripling down on yield curve control, and their currency is suffering as a result.
Because, Jurrein, just to go back to the point we raised earlier, my hypothesis here, both you and I spend a lot of work looking at network effects and the adoption curve, right? It's clearly a logarithmic trend that is exponential in linear terms over time as adoption drives the value of the network. And you've done huge amounts of work on that. I've done huge amounts of work on it. We both tend to agree that this is one of the larger network adoptions that we've seen. So the trend is up and to the right, even though it's volatile. So the macro that seems that the only macro thing I can see that really affects it seems to be year-on-year rate of change of M2, as you were talking about. And we've got to this negative year-on-year rate of change of M2, which is generally the bottom of the Bitcoin market and the crypto markets overall. Okay, fine. So that looks right. So what we're both trying to say, which is why the macro is so important here, is we're both saying, listen, it's unlikely that M2 is going to remain so negative. We're already seeing China increasing its M2. So even if we don't return to QE and massive rate cuts, let's assume we don't. I actually think we're we'll get some of that maybe later, but irrelevant. But because the chart is up and to the right, you're holding a ball underwater, a beach ball underwater. And the moment M2 stops contracting, the ball rises. Just because of the, is that how you, so, you know, I'm very, very focused on crypto again right here. I'm very focused on bonds, very focused on crypto. And it feels that the crypto markets want to start pricing this. How are you thinking through that?
Yeah,
Does that make sense?
I agree with that. I think Bitcoin and the rest of crypto just has to survive this winter of deleveraging. You know, it's the winter of our deleveraging, and because that's an idiosyncratic thing where, you know, we all know the stories of who blew up and this and that, and clearly that whole kind of balloon is shrinking, which at the end of the day, of course, will be I think a very big opportunity, because then you can get in based on the fundamentals, which, as you mentioned, you know, the network adoption curve is up and to the right. We don't know the slope, but it's still up and to the right. But it's nice to be able to get in when you don't have to worry about if some person is going to get liquidated and drive another 10,000 points, you know, down.